Hey, what's up, guys? Welcome back to the channel, and I hope you're all doing well. This is another portfolio update. So let me walk you through my portfolio, some recent business updates, and where my dividend income came in at. Let's jump right in. So let's start off by looking at my portfolio to see what major movements are happening as of right now. So taking a look at ATCO and Allied Properties, these two holdings, I'm seeing a drop of about 4.6% and 3.2%. That's this right here. But if you factor in these dividends, the loss does get a little bit better, but still I'm down a decent chunk. Right now, both of these are below my target asset allocation, coming in at 1.8%. So this is something I track heavily for my portfolio. If my holdings go below whatever threshold I've set, so it's very likely the next time I look to make a buy, I'll be picking up shares of these two entities to try and bring this back up to around 2%. And the other thing is that with ATCO and Allied Properties, they do pay a nice yield, 4.2% and 3.98%. So if there is a sale for these two holdings, they're below my target asset allocation, I'm picking up these two shares. If we look at these three guys right here, Aecon, Couche-Tard, and Brookfield Asset Management, I'm seeing double-digit gains so far, although the gain is not as high as it was last month. I think earlier, about a month or two ago, these were definitely up 20-something odd percent. But you know what? That's the nature of long-term investing. You will have major increases, and you will see some drops. But the key goal for you as long-term investors are look at your positions, analyze your holdings. Do they still stick with your investment thesis? Are those long-term holdings still providing you with the value that you're looking for? And if they are, whether the market is up or whether the market is down, does it make sense to add to those holdings? So for me, for Aecon, Couche-Tard, Brookfield Asset Management, if they fall below my target asset allocation, I will definitely be picking up more shares. If you're interested in what shares I'm looking at, I post on a monthly basis my 5 dividend stocks that I'm currently looking at for the month. But beyond that aspect, in terms of my analytics, the one thing I use is the spreadsheet. So if you are interested in the spreadsheet, make sure you check out the link in the description below so you can grab a copy for yourself. So you can use the exact same analytics that I use to make my investment decisions. Aecon is well above my asset allocation target at 1.7%. My target for this particular stock is 1%. So for the next little while, until it doesn't go below that 1% holding, I'm not picking up more shares of Aecon. And for ATD and BAM, ATD I like to keep around 2.5% and BAM at around 4% or so. With Aecon, I have a pretty good yield at 3.6%. But with ATD and BAM, the yield is not as high, but this portfolio is not about having only high yield stock picks. I like to have a mix of both. And you'll see later in this video, I'll showcase all my holdings by their yield. So you can see some of my larger yield holdings and some of my lower yield holdings, exactly like BAM and ATD. BIPC, Brookfield Infrastructure Partners, this is down 12.18%. My book value is $86 a share and it's currently trading at $75 a share. So why is BIPC seeing such a major drop? If you haven't already kept up, it's because of their Interpipeline purchase. Brookfield Infrastructure and Interpipeline have announced subsequent acquisition transaction and completion of offer. After months of back and forth on this takeover offer, things have finally settled, and Brookfield and Interpipeline have announced a completion of offer. Brookfield Infrastructure has taken up all Interpipeline common shares that were tendered under the offer, including 33.1 million common shares that were tendered during the mandatory extension period. Brookfield Infrastructure will acquire 100% of Interpipeline's common shares. And under the terms of this arrangement, holders of Interpipeline common shares other than what Brookfield already owns will be entitled to elect to receive the same per share consideration as set forth in the offer. And because the market believes that the combination of Interpipeline and Brookfield Infrastructure Corporation is overvalued, that's why we're seeing a 12% reduction in the stock price to bring it more in line with the market's expectations. This is the next one I really want to talk to you guys about. I've been holding on to BMO shares for quite some time now, and I haven't really added to my position for a while now if you've been following my channel. It's because of, again, going back to my asset allocation target. I didn't want to overexpose myself to BMO because it was already around 6%, so I've been waiting for the rest of my holdings to sort of go up in valuation by adding more shares or by just the market movements. And because my portfolio has grown due to contributions and market movements, and now that it's fallen below 5%, I can actually go ahead and pick up more shares of BMO. These banks make a lot of money. They will continue to grow. They've been around for hundreds of years. I've been paying consistent dividends. It's really hard to pass up on an opportunity to pick up more shares of BMO, Rollbank, or TD. It's currently paying a pretty healthy yield at 3.7%. You'll notice that my book value on BMO is $115 per share, where the current market price is $127. So just between the book value and current share price, I have a $12 gain per share. Now, for those wondering what's happening with my Bitcoin and Ethereum holdings, well, here you go. The Bitcoin ETF I have in my portfolio, I'm up 15%, but it only makes up 0.5% of my overall holdings. And whether I'm picking up more units of this Bitcoin ETF, well, it all depends on, again, this target asset allocation. If it probably falls below 0.5, I'll probably pick up more units and see where that goes. CPX, I'm up 11%. It's also below my 2% target asset allocation, so I'll probably pick up more shares. Another one that's on my radar is Dollarama. I'm pretty much flat on this holding. So my book value per share is 56. It's currently trading at 55.96, so I'm about 50 cents per share below the market price. Not a high yielding stock, but there's a lot of growth potential I see with Dollarama. And that's why I sort of set my target asset allocation at 1.5% of my overall portfolio. Likely the next time I look to invest, I'll probably pick up, maybe a share or two of Dollarama just to bring this back up to 1.5%. ECN, if you guys have not already heard, ECN Capital, they are selling about a third of their business. And around Q4 of 2021 of this year, they are looking to pay $7.5 of dividend per share after their sale of their business settles. And if you notice, the current stock price is currently trading around $10 to $11 per share. Dividends are no free lunch. What does that mean? Every time a company pays a dividend, theoretically, it should see a reduction of the dividend's value from its stock price. So for example, a company has a stock price of $25 a share. They pay out a dividend of 50 cents per share. Theoretically, that company's stock price right after the dividend should be valued at $24.50. But because of market movements and market noise and traders buying in and out of positions, you don't really see that impact. But with ECN paying a $7.50 per share dividend and it currently trading at that $10 to $11 per mark, in theory, what should happen is that after this dividend gets paid out, we should see a major reduction in the stock price. Empire, this is something else I'm down about 2.5%. It's about 1.8% of my overall portfolio. So probably I'll pick up more shares just to bring us back up to around 2%. Enbridge, I'm currently up 10% on this holding, pays a really nice dividend. And because it's below 4% of my target asset allocation, I'll probably pick up a share or two next time I'm looking to buy. Ethereum, I'm up 29%. It's currently at 0.6% of my portfolio. So I'm just going to wait and see if either this goes up or down. I don't know, I can potentially take some profit off the table. Granite REIT, this is another one of my favorite holdings. I'm up 19%. This sector of industrial warehousing has so much more potential with Amazon buying even more warehousing, more companies getting involved in the logistics business, 1 hour delivery, next day delivery, same day delivery. We're just going to need more and more warehouses. And that's where players like Granite REIT come in because of their exposure to all these industrial warehouses. They'll add more warehouses, they'll collect more rent. That rent gets paid down to you, the investors. So I'm holding Granite REIT for definitely the long term. Magna's another good story here. Just like BIPC, I'm down about 11-12% on this particular holding. And if you look at my asset allocation, it's at 2.8%. I'm hoping to keep Magna around 3% of my overall portfolio. So very likely the next time I buy, I'll pick up another share or two of Magna. So there is a potential merger happening between Magna and Veoneer. And that's what's keeping the share price down. Again, every time there's a potential merger in the market, you can either have a really big uptick or a major drawback based on the market's expectation of valuation. So just like what you're seeing with BIPC and Interpipeline, the market doesn't value the merger at the current stock price. So we're seeing a drop with that group right there. If you believe in the long-term impact of electric vehicles, more and more technology adding into our cars, making them smarter, I think there's still a lot more potential to come from this group. In terms of my overall portfolio, I still have another major loss in Sylogist. This holding, this one bothers me. I mean, it's currently at 0.7% of my overall portfolio, so it's not like I'm at a major loss here. Where my head is thinking right now, it's currently at 0.7%. It's not a major investment of my overall portfolio. So I'll probably just stick with a wait and see approach. See, does it go up? Does it go further down? And I'll make my assessment at that point. And if you've been following the news, you'll know that CP and Kansas City are well on their way to a merger. CNR has lost out because of regulation issues in the United States. However, based on their latest press release, CNR has another strategic plan. They have an ambitious value creation plan targeting $700 million of additional operating income, as well as a 57% operating ratio for 2022. They're leveraging previous strategic investments and the strong condition of the existing network, which will bring capital spending down approximately 17% of revenue for 2022, while retaining commitment to safety and customer service. And here's another big news. CN will resume their share repurchase program previously authorized by the board of directors, with remaining $1.1 billion in share repurchases to be completed by the end of January 2022. So while CN may have lost out on Kansas City, it looks like they have moved on and have come up with another strategic plan to create even more value for shareholders. Overall though, if we take a look at my entirety of my portfolio, you'll notice I currently have 874 shares of these various holdings. My total book value is just under $42,500, and my market value is $44,408, which gives me an open gain of just shy of $2,000. Factor in my dividends, and this is where the focus of the portfolio is to generate dividends. Then I can take those dividends and spend it wherever I want. That option is completely with me. I can do whatever I want with those dividends. I can reinvest, I can buy things, doesn't matter. I have that choice. And that's the goal of this portfolio, to continuously generate more and more passive income, so I can make use of that passive income for either everyday expenditures or whatever else I want. So when you factor in these $300 worth of dividends, overall, I'm up $2,241, which gives me a total return of 5.28%. In terms of an overall yield, my portfolio is currently yielding 2.86%, and that is exactly in line where I had set. I was targeting an overall yield just around the 3% mark. Just for me, 3% is not too low where I'm not getting enough cash flow, but it's also not too high where I'm risking major dividend cuts. So overall, as you can see, for the month of August, I brought in $100 of dividend income. This is income that I did not have to work for. This is income where I didn't have to trade my time in for a job. This money came in irrespective of whatever I was doing. Whether I was sleeping, watching TV, or working on creating more content for you guys, this dividend shows up day in, day out. And that's why I like the power of dividend investing. It enables you to take more control of your life. Just think about it for a second. If you have enough dividends or enough passive income or an income from a source that you're happy with, you don't have to work at a 9-to-5 job that you're unhappy with. You have options. And that's the whole point of why building passive income is such a powerful concept, because it allows you to buy back your own time. It's $100 where you don't have to work hard for. Let's say you have a job that pays you $20 per hour. If you brought in $100 worth of dividend income, that's 5 hours of your life you didn't have to spend on a job you just got paid for doing absolutely nothing and just simply living your own life. And as you can see, instead of receiving one paycheck from a regular job, I received 12 paychecks from these different companies throughout the month of August. Dividend stocks, or stocks in general, are not just ticker symbols. Long-term investing, owner mindset. Taking a look at my activity for the month of September, my largest trade for the month so far for September was VGG, which is a US dividend ETF. And what is VGG? VGG is an ETF that tracks a market cap weighted index of US companies that have increased their dividends for 10 or more consecutive years. I don't have to pay any FX or foreign exchange fees because VGG trades on the TSX. So I can buy shares of VGG in Canadian dollars, and the dividend income I receive is US dollars converted into Canadian dollars. So I get exposure to a basket of some of the best US dividend paying stocks with this just one holding. So in terms of market performance, you'll notice I actually had a larger gain in the month of August at around 2.4K. And the gain that I have right now is 1.9K. And I've done nothing but add to my portfolio. So the market has not been as strong as it was in the month of August. But as I talk about in these videos, my focus is not this open gain or loss. My focus is dividends. Irrespective of whether the market is up or down, my passive income has gone up, and that's what I really care about. What I'm doing is I'm looking at the work days in the month of June, July, and August for the last quarter. This is the dividend income I brought in each of those months. So when I add it all up, That means in the last 3 months, I generated $262 of dividends from those 3 months. Those 3 months also had 66 work days. And if you times that by 8 for 8 hours a day, that gives me my passive income per hour at 50 cents. I'm generating 50 cents per hour for doing absolutely nothing. And the best part is, the more and more I add to this portfolio, that number only goes up. Think about all the effort you have to do in your job just to get maybe a 2-3% at most annual merit increase. Whereas as long as I just invest money, pick the right companies with the right ETFs, my money grows for me. It does all the hard work. And that's the power of passive income. And that's something I make a focus on this channel, how to build passive income, how to grow your passive income so you can buy back your very own time. Because I want to share my performance with you to motivate you to build your own passive income. Buy back your time. Life is short, make the most of it. In terms of my top 5 yielding stocks, I have Enbridge, Smart Centers REIT, BCE Bell Canada, TRP, and CPX as my top 5 highest yielding stocks. And here are my lowest yielding stocks / ETFs. WSHR, which is an ETF, Dollarama, Waste Connections, Dream, and Couche-Tard. My overall portfolio yield is around 3%. Now, one thing to keep in mind as dividend investors living in Canada, that I honestly believe that 100% of your portfolio should not just be based in Canada. Something to keep in mind is that Canada only makes up 3 to 4% of the world's economy. If your portfolio is just 100% based on Canadian returns, you're missing out on those broader economic returns you just can't get in Canada, because there are total returns to be had beyond Canada's borders, and that will always be the case. So that's why I like to dedicate a portion of this portfolio with ETF that give me exposure to companies outside of Canada. So that way I'm not just entirely dependent on this one country. I have worldwide exposure, worldwide dividends coming into my portfolio by just sitting at home. And why do I like dividend investing? Because irrespective of what the stock market is doing, I can put my money to work and just move on with my life. And over time, I'm expecting my dividends to grow, regardless of what I'm doing, regardless of what the market is doing, as long as I'm picking the right stocks included in my portfolio and hedging my bets with ETF for exposures that I can't get in this country. And for the most part, my dividends should continue to flow in and endure over time, because I get paid to remain an investor. And to me, that's a very powerful concept. Thank you so much for watching. This channel would not exist without your love and your support. If you've enjoyed this video or any one of my other videos, consider hitting that super thanks button on the bottom of this video. It's a new way to directly support your favorite content creators on YouTube. Or if you'd like, you can buy me a virtual coffee as another way to support my content and the channel. All proceeds will be used to bring you even more value-added content that I hope will leave a lasting impact on your investing journey. So if that sounds good to you, check out the link in the description of this video to buy me that virtual coffee. And on that very same page, you can download my custom-built Excel-based dividend portfolio tracking spreadsheet, which I use to track my own dividends, forecast my dividend income, and track my gains. So you can keep track of your portfolio exactly the same way I do. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know your thoughts in the comment section. And while you're at it, make sure you've hit that like and subscribe button or that thanks button. That's it for now. I'll talk to you in the comment section.